This morning, big tech putting the S&P 500 on a 6-month winning streak. Belski, the founder and CEO of Humulus Investment Strategies, saying stocks have more room to run. He's calling for the S&P 500 to hit 7K by year-end. Brian joins us now for more. Brian, good morning. Good to see you, sir.
Thank you so much for having me.
Congratulations, unshackled by corporate culture. What's the new approach going to be?
Well, it's going to be the same old song and dance for Belski. I'm just going to continue to do my best for my clients and their clients, and we're going to try to give our best market views. And, you know, fortunately or unfortunately, this is my 36th year doing this. I started when I was 8 years old, clearly. And I've always said this, when you look at the market, I've always tried to think about how you're going to invest in the market. You know, so many people that do what I do, they want to make the big market call and the index call. And so our first rule of investing is like stocks lead earnings, which lead the economy. And the stock market is a market of stocks. So when for instance, when I look at tech, and I've been bullish on tech for a long time, what are the parts of tech where I want to be in? And, you know, rule number 3 of investing is you don't have to know everything. So many people in our business, they think they know everything. They need to be the smartest person in the room. So our tagline at Humulus is investing with conviction and humility. And the conviction part of it is, if there's 500 stocks in the S&P 500, and we run a large cap focused portfolio, we own 50. I think I have pretty good knowledge of the 50, the 100, the 450. I don't need to know all of those. So that's kind of how we've thought for all these years.
What do you need to know right now? What are you focused on?
Well, in my notes preparing, I'm a little bit worried that there's too many bears or too many bulls right now, and I'm very self-deprecating and I think about Belski. You're starting to firm at the top of the market. Well, for one, I don't think the top of the market's here. I mean, we've been on record since 2009, 2010 that the U.S. stock market has entered a 25-year secular bull market. People thought we're Pollyanna and always bullish and blah, blah, blah. In that time period from then until now, we've had several cyclical bulls, cyclical bears. We're going to have another cyclical bear before the end of this as well, everybody. But everyone kind of jumping on top here. I think that's a little dangerous, but at the end of the day, we're investors, and so what we're going to continue to do is run value money, run dividend growth money, run small mid-cap money. And Alicia's right in the hit before before we spoke, we are going to see a broadening out of the market. I think we're heading into Goldilocks. I think we're heading into where you have to own a little bit of everything, not just tech, not at the forsake of selling tech, but continue to be a fundamental bottoms-up investor. Let the market do what the market does.
So can you develop that, especially given the fact that you're seeing profit expansion disproportionately among the big tech players? It hasn't been in the discretionary shares to the same degree. So even when you look at the fundamentals of a lot of these companies, what gives you confidence that's going to shift, and that could be leadership?
So one of the things we've looked at for decades are earnings revisions. We use a diffusion index, Lisa, where we look at FY2 versus FY1 and the relative change in earnings. That's what kept us bullish all this year. We're starting to see a relative improvement. Remember, you don't buy at the top or sell at the bottom. When you start to see things improving, and we're seeing things improve on the other within the other areas in the market in terms of broadening out. With respect to the cyclicals, is a great question. So if you're heading into a period where 10-year treasuries are going to be more steady, and a period where you're going to have a broadening out of the market, we want investors, in the way that we're looking at portfolios, we want to become more cyclical in consumer discretionary and more cyclical in industrials. If you take 2 steps back and look at where the performance has been in consumer discretionary, especially this year, it's all Tesla and Amazon. And more defensive areas like TJ Maxx, great company, we've owned it for a long time, but I think we want to get a little bit more cyclical in our consumer discretionary holdings. In industrials too, we've had a great run in some of the international industrials, but I think it's going to be more domestic. That's what's going to, I think, do much better.
I love that you've always been called the biggest bull on Wall Street, and you start a fund that basically means humble, and you're coming out here and you're talking about a price target, I think of something like 7,000 for the end of the year. I'm just wondering, could you see a price target for the S&P 500 at the end of this year and next year that isn't far away from where we are now, but potential for real outperformance if you go to some of the laggards of the past year?
So believe it or not, I mean, we are very convicted in what we say and how we communicate.
I'm shocked.
Shocked, right? right? We say what we mean what we say. We, in our entire career, have set up analytically and personally to underpromise and overdeliver. If you put out a big number, it's always hard to meet that. We've said very clearly, we said it during COVID, and we said it again this year with all the silliness with respect to the tariffs. Market targets are an academic practice. You are in life, you do not run your life through a spreadsheet. You run your life through what's happening, right? And so I think that's where many of my cohorts got wrong. We put out a 7,000 bull case in our year ahead piece that we published last November. We said the bull case for 2025 was 7,000. So we've been there since November. Now the bull case is beginning to shape up. Earnings, as you said, are starting to go. The operating performance of companies in terms of return on equity, return on invested capital is beginning to turn. That looks all really, really great and all part of our process for several years. So there's no doubt that the market's probably going to eclipse that 7,000. But if you go back into the historical normalcy, if we can ever be normal in this business again, I think we're going to head back into, at worst, high single-digit, low double-digit performance, 3.5 to 4.5 on the 10-year Treasury, double-digit earnings. That's a pretty good place for stocks. And I think as investors kind of come back into really the best house in an improving neighborhood, the U.S. is the best house in an improving neighborhood, it used to be the best house in a bad neighborhood in terms of the rest of the world. I think investors are going to calm down and use equities as a place for stability relative to their other assets.
When you say silliness of tariffs, do you mean tariffs are silly, or do you mean the about face we saw from the administration?
I'm thinking the silliness in terms of the reactions from investors. So, for instance, we were at BMO at the time, has been an amazing partner for the last 13 and a half years. It was just an amazing place to be for all that time. And we were literally receiving emails and calls from advisors in Canada saying their clients want to sell U.S. And what we said in a research report we said, we own what we own. We own what we own. If the market goes down and these stocks go down, we're going to buy more because we believe in the names that we own. And so that created a situation where fear was driving things. You should never live your life by fear, and you should never run your portfolio by fear. So that created, again, very humble to say that was our best quarterly performance in the history of running money, second quarter this year. And so we think that anytime you do that, so the silliness is exactly that in terms of this exogenous type of talk.
Can I jump in, Brian? What do you think really drove sentiment? National pride or price action?
That's a really, really great question. Well, remember, if you take two steps back and look at what's happened, and we're becoming more populous around the world, and I think sentiment is driven by again, life is like investing is like life. It's not so much what's happening in terms of the stock market. If you walk down the street and our great partners in Canada, you walk down the street in Bloor Street in Toronto and you say, hey, do you know that the Canadian stock market is outperforming the U.S. stock market? Canadians go, oh, I don't know, I didn't know. They have no idea because they're reading the Globe and Mail, they're watching the TV, they're scared. So it's sentiment. And then they're talking to they're having Thanksgiving in the United States coming up. People are not going to understand that the stock market's at all-time highs. I think 2 generations from now, my grandson's children are going to be talking about this stock market. They're going to be talking about the stock market, that this is one for the generations, that the majority of people, remember, the majority of people between 2009 and COVID missed this market.
Yep.
They missed it.
Looking forward to tracking it with you.
Thank you so much.
Congratulations, sir, and thanks for being here.
Thank you.
Thank you. Brian Belski of Humorless Investment Strategies. When he called me up and we talked about this new name, and I said, well, what does it mean? And then he told me, I burst out laughing.
Well, because he's very bullish, he's got a lot of conviction, but humble. That's how I think of you. I think of you as a humble, restrained person.
Convicted is how I think of
Yes, absolutely.
Brian.
And right, frankly, a lot of the time.
Particularly over the last 10 years, that's for sure.